Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Now, the energy sector has been shaken up by headlines around both Venezuela and Iran, but there's much more to the story beyond just those two countries. So joining me now is Jan van Eck, CEO of Van Eck Funds, along with Jennifer Grancio, the global head of distribution for TCW and former CEO of Engine Number One. Thanks to both of you guys for being here with us on ETF Edge. Let's start the conversation with a broader-based look at just what's happening around the news and energy. And Jan, for that, I will turn to you. Just how important have these recent headlines involving both Venezuela and Iran been to what has been the investing landscape for energy and energy stocks going into 2026?
Well, we're in Trump administration 2.0, and the president has said, I want more production, which is lower prices, or at least not rising prices. So energy companies have this big headwind. And I think in general, if you look at Venezuela, I don't think it's the biggest macro event in the world. So we at Van Eck have, divided the energy world into miners, refiners, explorers, like nuclear, right? All different components. But I think the core old energy world is just a sideways world right now. It's hard to see. There's a lot of supply out there. There's supply of gas too, so I'd say not that exciting.
So when you say old energy, that implies there's also a new energy. So when you take a look at the way that the ETF world, the investing world has shaken out, just how much more attention is there now to old energy, hydrocarbons, oil and gas, versus some of the new energy themes we've centered around AI? And Jan, I think you have an interesting take on this.
Yeah, I mean, look, I think these companies need to lean into electricity, which is different than energy. And that's where the demand is coming from. The hyperscalers, the AI trade, we call it AI 2.0 trade. The ETF that we offer that's benefited the most is nuclear. A ton of performance last year, a lot of inflows. And even over the last couple of days, there's constantly announcements because there's two components to electricity. I call it the QR code. One is quantity. Well, we need more electricity. But the other is reliability. I don't think that R word is really understood well enough. Data centers can't be down. They can't take an hour off. They need the highest level of industrial reliability that exists. That's actually true for some other customers like the military and things like that, right? You don't want to have an airspace go down for an hour. So reliability is something that's also benefiting nuclear.
Now, Jennifer, the curious part about the energy trade right now is just how much, to the question I just asked Jan, is the emphasis on what is the traditional older gas players and oil players, if you will, versus what the kind of power need and the energy need will look like in the coming years and decades. Just how much are investors in a transition phase in your mind right now with regard to kind of making some of the differentiations between the two, and how is that investing landscape evolving towards a certain type of company or a certain type of investing that we haven't seen over the course of the last few decades?
Yeah, I think the energy transition is going to happen over a very, very long time frame. And as Jan just said, from a power transition perspective, that's almost how we think about it as TCW. That's essential. And that's where a lot of the activity is coming from. And so we think that we need all energy sources in order to feed the beast in terms of the demand for electricity, power for data centers, power for manufacturing and driving the growth in this America's block from a geopolitical perspective. We think that we need all sources of power. At TCW, we invest, we're an active investor. We think this is a market where you want to be selective and you want active investors. And thematically, we manage an ETF that ticker is powered. And what we do in that fund is we're very broad. So we are holding some old economy companies, but a lot of what we're investing in is nuclear, both larger scale nuclear, sources of nuclear energy, and then companies that help us with efficiency of power. So for example, if you think about nuclear, we saw the announcement from Meta with one of our portfolio companies, Vistra. Meta is contracting within the next 10 years to add as much power as New York City uses now. I mean, think about the enormity and the scale of that. And so nuclear companies like Vistra are an important part of how, as Jan said, we get that regular power without the intermittency gaps that we have on some of the newer technologies.
Jennifer, just how much has TCW, the funds that you have they seen some of this kind of interest and I guess flow into these particular themes? Do you feel as though this is a ramp up kind of strategy for you guys that has legs? And if so, what is the primary reason for driving some of that investor interest? And beyond that, how much more do investors have to learn about this energy transition in order to see some of those themes really take off in the coming years?
Yeah, I mean, when we look at the average portfolio, people have index funds. They're relatively well covered on the biggest tech names. But when you think of the scale of all of the companies that have to provide infrastructure and software and new sources of power, either on the AI space, we also run an ETF AIFD, which is the oldest broad investment in AI portfolio in the market in the form of an ETF. And then with a fund like Powered, we're investing in a way that's very broad so that as time moves forward, these themes are going to change. The winners and losers are going to change a little bit. And so our approach as TCW is we're managing the strategy for you in a very broad way. You can invest with us, and our portfolio managers will move the portfolio around as opportunities emerge. And as we go through what we think is going to be very exciting, but there will be some volatility in how we invest in both AI and sources of power and electricity in the next couple of years.
Jan, there is a case to be made right now that you could gain some of this exposure just towards traditional, maybe index-based ETFs and funds, ones that just track the overall industry, ones that you can just get some exposure to. There's another case to be made that you want active management, a portfolio manager, a research team that kind of goes through and evaluates some of the pros and cons and makes a fundamental decision about these types of companies. Just what role do active ETFs and passive index tracking type instruments play with regard to kind of how you invest in this energy transition in the coming years?
Yeah, I think probably agree with Jennifer on a couple of different points, right? That this change is so dynamic that you want a mix of the old and the new. And so even some of our pure play ETFs like oil services, like how many companies in that portfolio are really leaning into this transition on the electricity side? Not many, right? So the ETFs that we like actually in the space are the actively managed ETFs. So we have one that has more of a crypto background. The ticker symbol is NODE, N-O-D-E, but half of that portfolio is now leaning into the electricity transition. About 30% is Bitcoin miners that are, kind of leaning into AI transformation and doing deals with the hyperscalers, and 20% are the power producers like a Vistra. But even Vistra, which is now a large cap, it became a mid cap and now it's a large cap, so that's in your S&P portfolio. What's interesting to me about it is, sure, it had a natural gas generation capability, but even in the last 2 years, it's leaned into nuclear. And so nuclear it's that R in reliability that I want to stress that their customers are looking for. Not that gas isn't reliable, but the old alternatives of solar and wind are really not suited to what hyperscalers are looking for.
Interesting, Jennifer. There is also, I guess, a point that has to be kind of put out there. This idea that if you take a look at what's driving some of that stuff that's happening in the marketplace right now, Jan pointed out some of the kind of cap evolutions, right? That Vistra kind of was like a smaller mid-cap company. Now it's certainly a very large one by comparison to where it's been. How much do you think the investing landscape right now is about trying to find some of those kind of smaller and medium-sized companies that are going to evolve sentiment-wise and fundamentally to take advantage of some of these and become medium to larger cap companies down the line?
Yeah, we think that that's a huge opportunity. And so if you think about the changes we're describing, so from an energy perspective, if you go back really even 3 or 4 years ago, we were still relying on how much regularity could we get out of wind or could we get out of solar. That's very hard. You've had a huge shift towards nuclear. You've had all the incentives around nuclear. In the case of nuclear, you have large existing plants, but we need to service the large existing plants. We need small modular reactors, and all of that development is indeed creating new companies or smaller companies that are very quickly growing, moving up the cap table. And in some of these cases, there's one or two companies, it's almost an oligopoly, or there are only a few providers. And that's something where an index is able to pick up companies as they grow as well. But as an active manager, we're trying to look for those companies that are winners as we go through the transition. And we can put them into the portfolio when they're small or mid and hold them as they grow.
Jennifer, what exactly are those key traits, if you will, if you had to distill them to maybe a two or three kind of bigger themes or fundamental aspects of a company that would make them well positioned in your mind to be the ones that kind of lead that revolution from the small and mid-cap companies to larger ones down the line?
Yeah, I think it's as we go through this transformation where we need reliable power, you need to get it to the data center. Within data centers, we need to make data centers more efficient. You're looking for companies that are one or two in their field or the best at a certain technology. And you're looking for companies that play in that space. I'll give you another example is Vertiv. So Vertiv is a company that helps on data center cooling. So that's another example of a company that's really come up the cap table over the last couple of years because they're one of the few companies that can do it. And we have that desperate need for increased efficiency in data centers.
Jan, if you take a look at the way the ETF world is moving right now, there is a lot more growth in those actively managed ETFs versus the passive index tracking ones. In your mind, how much more important is it going to be for investors and the investment advisors that use ETF products to become more knowledgeable about just how this kind of power, energy, evolution is going to happen, and just how much or how important will it be for that fundamental analysis to play a part in how you select the instruments that you're putting clients into? Because not all active ETFs are managed the same way. By definition, everybody's got their own kind of secret sauce. Right. What exactly is that for you guys, and what exactly will it look like for investment advisors who are looking to use these funds?
I mean, I think it is hard, to be honest, right? Because a shifting portfolio means advisors don't necessarily know what exposures they're getting to. I mean, you can articulate a theme, but the market's constantly evolving. So I think it's going to be a mix of old school ETFs, to be honest, like something like our nuclear ETF. It's diversified between the miners, the producers, the utilities, and some of the new tech companies like Oklo. So that's very clear, I think, in investors' mind, but that's why we have to do a lot of education around Node, which is our actively managed one. That is a mix, just to follow up on your question. Jennifer, we've got some small caps. The Bitcoin miners are small, financially weak companies that are very leveraged into this electricity hyperscaler trade, but that also means you get a lot of volatility along the way. I think that's kind of clear in the crypto space. Like, no one's surprised you get a 50% drawdown in an ETF. But I think that those risk expectations need to be clearly communicated as well.
Jennifer, another point for you, just kind of before we kind of wrap up this conversation. If you look at the way that things maybe are being scrutinized with regard to how much investing attention is being paid to some of these types of products, is there a case to be made in the future that these power, energy, AI-related ETFs are going to then start to kind of bleed, if you will, stylistically with some other key parts of the market here? And then how exactly do investors, in your mind, who have a plethora of options at their disposal, start to really formulate their investment plans and theses around some of these bigger themes? Just how much do ETFs have to be scrutinized for their kind of subtlety and nuance, as opposed to maybe having all of these investments go to one place and then having maybe an overweighting in certain places that you didn't think you were going to have?
Yeah, I mean, I think that's always a good question as markets grow and change is, what did you buy? What are you holding? And how does it all work together in the portfolio? And the way we think about it at TCW is that there are some end investors who are working with a financial advisor, they're working with an institutional consultant. And so it falls on those groups to make the more tactical decisions. There are other people that are very direct, active investors who may constantly be watching all the names that we're talking about. So at TCW, the way that we build AFID or Powered, the two AI and the Power ETF, the way that we build them is very broad, so that in an overall portfolio allocation, you could take 10% out of large and mid cap and you could put that 10% in powered and AI to kind of take advantage of these big themes, but rely on what our portfolio managers are doing in terms of understanding risk, constantly doing fundamental analysis, looking at valuation. And so our approach to that as TCW is to give you broad exposure to the themes so that you can stay invested through time. And you don't, as an investor, have to do the micromanagement of overlap of what would naturally be in a power versus an AI versus a core index product.
All right. And Jan, yes.
Just to follow up to that,
Sure.
I think that's a phenomenal question. Portfolio construction and the trend towards model portfolios, I think, is really important. Because even these themes, first of all, you don't want to overweight them in your portfolio, but also you can, if you have a good model manager, you can harvest profits, right? So our nuclear ETF was what I called at nosebleed levels coming into the fourth quarter, and it corrected substantially, and now we think it's much more attractive. But how is someone going to operationalize that? That's where I think model providers and gatekeepers play a big role.
Sure, and risk management's obviously going to have to evolve with those types of models and their evolution as well.
Yeah.
So, perfect. All right, Jan van Eck, Jennifer Grancio, thank you both very much for being here with us. We've asked Jennifer to stick around for the ETF Edge podcast. You can catch that and all of our other content at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.